In terms of, I suppose, the context of this, we have always and had a long-term time concern for consumers that were in mortgage difficulty based on the cases that we were seeing. Then, as I said, we got a ministerial request for some data, and that presented the opportunity that we had. We are in a unique position for comprehensive data that's not just, the numbers of people in arrears and how long they've been in arrears for, but actually, what impact is it having? What's their experience of the code? And it was quite surprising in some ways that the kind of actual empirical data bore out the anecdotes that we had, particularly in relation to timelines and delays and things like that. In terms of, I suppose, the research findings, the report is broken up into kind of 6 sections, but 2 main ones. One in relation to the client profile, so how are they engaging with mortgage difficulty and what is the impact on them, and the other in relation to their experience of the Code of Conduct and Mortgage Arrears that was generated to help mortgage lenders, to help mortgage clients in difficulty. Now, I understand that the new code has a much more, bias is the wrong word because it has obvious connotations, but it was drafted from the perspective of the lenders, and the central bank make no apologies for that. It is a lender's code as opposed to a borrower's code. So in terms of the client profile, we looked at location, household composition, age, employment status and income, the mortgage lender, so subprime, local authority, other, and the level of non-mortgage debt. Essentially what we found in terms of location was there was a huge concentration in urbanised areas, and the reason we're using kind of urbanised areas is that it was places that were built up, that were never meant to really be urban areas or hadn't established themselves properly. They were kind of boom urbanised areas. There was also a strong correlation with the census 2011 data in terms of those who are mortgaged, and you can see kind of the comparison there, and you can see it in the booklet itself. In terms of then the code provided for a definition of primary residence, that meant that you didn't have to actually be living in the property that was mortgaged in order to come under the code. And we found that 6% of the MABS clients in this survey sample weren't actually living in that property at all, that they were living with family and friends, they were living in private rented accommodation, and there was one specific case that I actually found quite upsetting at the time, that they were living on the streets, they were living in transitional accommodation for the homeless, even though they had a mortgaged property that wasn't, the rent of which wasn't actually covering the mortgage. In terms then of household composition, the majority are family homes, so high proportion of people with children, much higher rate than when compared with the MABS national data in relation to all debt types, and higher again when looking solely at the non-mortgaged clients as distinct from the mortgaged clients, a much higher percentage of those who are married with children. And again, there's a graphic in the handout there. In terms of, I suppose, the societal and generational impact of that, we would have concerns, and one of the recommendations that I'll go through a bit later on was around kind of more research that needs to be done in this space. With things like split mortgages and debt for equity swaps, there's a much longer term now, and if people are retiring at 76, 77, 78, the only recourse potentially is to have an intergenerational piece, and that will bear out. But again, the demographics of the people that we certainly are seeing, the ability to service a mortgage even throughout the generation is questionable. In terms of the age, again, this was quite surprising, and there was a lot made of it in the media at the time. A lot of them were coming up towards the 65 and above. And that again raised concern when you kind of thought about, well, these people surely should be paying off their mortgage by now. They should be coming to the end of that term. So I did a bit of digging around the types of lending that had come about between 2005 and 2012. They're published every quarter by the IBF PwC reports. And this kind of graphic I just kind of stuck together really shows why we're seeing what we're seeing in terms of age profile, because the majority of mortgages that were lent at the time were in relation to mover mortgages, top-ups, remortgages. They weren't in relation to first-time buyers. And there was a huge sense, particularly with the central bank and IBF, that it was the first-time buyers that were getting into trouble because they bought at too high a peak, didn't have the income to service it, we were trying to get on the ladder, and sure, then the ladder fell down, when actually the people that we saw that were in the biggest difficulty were those that would have been quite comfortable had they not topped up, that would have been coming to the end of this. And that again kind of, I suppose, links in with the household composition of those who have children and have quite large families. Again, then, in terms of the types of lender, I'm very happy with the alliteration here. We the majority of our sample were with mainstream lenders, and again, that was something that had been talked about before this report certainly came out, that it was the majority of subprimes that were in trouble, and it was really the subprime bubble that had burst. That wasn't our finding. 83% were with mainstream mortgage lenders, so your mainstream banks. We did have some subprime. We had 13%. Now, it's low comparative to what we have overall, of course, but when we compared it to the data from the central bank, only 10% of all impaired mortgages are with subprime. So we had a slightly higher contingent. Again, not surprising for MABS, but overall quite surprising in terms of the higher volume of subprime. 3% for the local authority. Again, a relatively high comparative figure when you consider that less than 1% of all mortgages are with local authority lenders. And then 1% with others, so foreign lenders and credit unions, which came as a surprise to me. Moving on from there then, we had a look at non-mortgage debt, and this is something that MABS has certainly been harping on about for quite some time in terms of, there's a lot of push on in relation to mortgages, or there was a lot of push on in terms of, dealing with the mortgage crisis, but the crisis coming behind it was personal debt. And our feeling on it, and certainly from casework, was, you're going to pay your priority debt, your accommodation expense, come hell or high water, but you may have let the utilities go, you may have let the credit card go. So there is a consistent problem. If you're in proper difficulty with your mortgage lender, chances are you're in difficulty with a whole heap of other things as well. So in terms of what we saw then, we had 50% of our client, or our sample client, had between 2 and 4 other debts. 5% had 10 or more. Now that really, that's a massive amount, particularly when you start to kind of drill into the numbers. So, for example, the way the MABS process works, we work on the basis of priority and secondary debts. Priority debts being those that have an impact directly on the client. So, for example, the consequences of non-payment are quite severe. Eviction, loss of essential utilities, loss of liberty, and also kind of we would prioritise anything that had to do with childcare costs and things like that. So, your real essential minimum standard of living type stuff. In terms of the priority debts, there were 1,000, so there was over a quarter of them. 1,238 of this sample had priority debts that were in difficulty, and that ranged from less than 5,000 to over 50,000. Now the majority was less than 5,000, but that would speak to utility bills really. It's not unheard of, but it would be unusual to have a utility bill in excess of that. When you get into the secondary debts, so things showed a completely different picture, and we had quite a lot with secondary debts. We had over 5,000 with secondary debts, and we had a crossover then of almost 20% or over 20% with both. The secondary debts figures, we'd almost a fifth, being in excess of 50,000. With some in excess of 500,000. Like the figures are phenomenal on this stuff, but that would be from kind of a shortfall on a previous property maybe, or a business that went bust. It's not unusual though to see credit cards ratcheted up, to see other types of unsecured lending that were in the 10s and 20,000s. In terms then of other factors that were associated, and I don't think anyone here would dispute this or be surprised by this, but there were some really, really heart-rending stories. And when I was carrying out this research, I took a couple of weeks off to write it up. And I spent kind of all day, every day, like some sort of ninja at the computer writing away. And my husband came home one evening and I was in tears. And he was like, "What has happened to you today?" And I had been reading through some of the stories because we got a lot of anecdotes from money advisors in terms of how their clients were experiencing it, and the types of stories that they were being told, and just, you know, absolutely heartbreaking things around husbands who couldn't possibly tell their wives anything because they were so worried about them, that, you know, the wife was in a mentally difficult position, and the husband just felt that they couldn't, but the husband couldn't bear it either. We had wives whose, you know, they were carrying a huge burden personally. You know, family members were sick, going through relationship issues, children were ill, going through school, and they were trying to pull it all together. And, you know, some of the stuff that we would see, certainly in casework, they know the Code of Conduct of Mortgage Arrears better than I do. You know, they have the provisions off, but it's the stress of everything else that they really struggle with. So we saw quite a lot in terms of relationship breakdown, physical and mental health issues, particularly around anxiety and stress, employment-related issues. So, you know, both obviously as a cause and a consequence, some with addiction issues, and, you know, then kind of other issues really around, you know, other kind of health issues and kind of the homelessness piece as well, and legal issues that obviously come from this, and again are a cause and a consequence depending on where they came in the pathway. In terms of the 2010 CCMA, it was a mechanism for lenders and borrowers to engage, and it was certainly sold as that, as being a mechanism for borrowers, for, you know, it was going to support them, it was going to get them through this process and get them back on their feet in a sustainable type of arrangement. It contained the MARP, the Mortgage Arrears Resolution Process, at which point had 5 stages: your communication, financial information, your assessment, your resolution, and your appeals. In the new code, as of today, appeals is no longer part of this process. It's a separate, it's still in the code, but it's not part of the MARP, so the communications provisions don't apply to the appeals provisions. Financial information was really around, you know, how long it was taking to carry out an SFS. We had a lot of toing and froing with lenders around the integrity of the process. So our process would cover from budgeting, income maximisation, reducing expenditures, all the way through, and could take quite some time, where we were, you know, hearing of experiences with lenders that was a 10-minute phone call. Now, obviously, I would think one SFS is going to look quite different to the other depending on the process that you use. So we had quite a lot of conversations around our process and trying to promote what we would consider to be best practice. In terms of the financial statement, financial information, then it does, you know, revolve around the completion of the 12-page SFS. Now, that hasn't changed, as I said, in the new code. But again, to give a borrower that, or a customer or client that, it can look like a very daunting document. Particularly, there's part D of it is all about the debts, and it's a massive table that goes from everything from, you know, who your lender is to why you got it out in the first place. A lot of borrowers can't remember why they got out an unsecured personal loan, you know, 5 or 6 years ago. It is, however, an absolutely critical part of the process, and what we found was that a lot of lenders were relying solely on the SFS in relation to how they assessed borrowers, where actually the assessment criteria had 5 pieces to it, one of which was the SFS. But because of the kind of concentration on it, we were really quite surprised that the integrity of the process wasn't following it up. Better budgeting, sustainable solutions, I'm mad for the alliteration. Again, we found that just by going through that process, particularly income maximisation was one of the key things that you could do for somebody now. You know, very little defence, as Paul Joyce would even say, to an arrears position. If you can't pay your debt, you owe the debt, you can't pay it. Defending that is difficult. So finding ways to try and boost your repayment so that you can stay in the property that little bit longer and hopefully come to a sustainable arrangement if your circumstances improve is absolutely critical. So that's what we would concentrate on and you know, try to find solutions for. In terms then of the resolution options, and there's a couple of bits in the document around that, because, you know, as we saw from previous slides, the majority, I think it's 55%, were at resolution stage. So we spent a bit of time kind of interrogating this. We compared it with the central bank data that, you know, is published quarterly, and we found that more money is being paid through MABS than without MABS. So the overall kind of national central bank figures, the majority are paying kind of less than interest only, reduced payments, deferred interest schemes, that would be 66% or thereabouts. We had less of those clients overall, but even with that, 69% weren't paying anything off capital. So the sustainability of those mortgages into the long term is questionable. Our recommendations then, just to sum up, we looked for sustainable long-term solutions that really took into account kind of the needs of the borrowers, but also in terms of, equity participation. Yes, split mortgages will help some people, but given the age profile, a balloon payment after the age of 70 odd isn't necessarily the best step for some. To have timelines at each stage of the MARP, so that we had that, you had a guarantee that you had to, your borrower would engage, or your lender would engage with you in this particular period, but also that it wouldn't be included in that 12-month moratorium period. We didn't win on that. A non-judicial regulatory framework, a proper non-judicial debt settlement type piece, because obviously the personal insolvency legislation ends at all stages with a court order. The pilot that's currently being considered by the central bank may go some way towards that, but it'll really wait and see what the outcome of that pilot is going to be. Also, we looked for some level of an income retention, some baseline figure, again, which would help this difficulty with affordability of payment proposals. We've sought for a long time mental health guidelines. All our pre-budget submissions talk about mental health guidelines in relation to debt. There's some phenomenal work done on this in the UK. And borrowers or lenders really engage with it, whereas here we don't have anything. The Mental Health Commission had a report last year that said, debt is a huge issue and there should be a guideline, so that the will is there, it's just operationalising it is the difficulty. Money management education, a huge piece, particularly again because we're seeing quite a lot of people, we're seeing quite a lot of borrowers in distress, but we're not seeing 100,000 of them every year. And again, if you're engaging on the phone, you need to have done your budget. You need to know what you can reasonably afford to pay, and you need to have had all of that thought process. That is a real education piece. For some, it's a habit-changing process. And if we could promote that kind of on a national level in some sort of a sustainable strategy, it would greatly help borrowers engaging with their lenders. And then finally, some further research being needed, around things like the age profile and the correlation between, top-ups and things like that, and mental health. And, there's quite a lot in this that could be done by other stakeholders, even in conjunction with ourselves. So with that, thank you very much. If anybody has any questions. Thank you.